the Fed were to cut rates to help growth, as you know, we saw the unemployment numbers, the revision of the unemployment numbers were horrendous. And it's funny too, because when the May and June numbers came out, like 250, 60, 70,000 jobs created each month. Gold went down, the stock market went up, and then quietly in August they say, no, not the 400,000 or 500,000 that we thought we created. It's actually only about 78,000. I mean, it's something like that. It was a massive reduction. So you're beginning to see the economy really slow down and layoffs happen. So arguably, this is what they're going to want to do. But this adds more fuel to the inflation side, especially with M2 already at a record. M2 is taken off. So when you have this happen, more inflation without boosting productivity, because I say that to you because we see the velocity of money at all-time lows. So they're trying to, it's like pushing on a string. They're trying to get all this money into the system, but the economy is slowing. You can see it through the unemployment numbers. You can see it through the lack of velocity. There's a massive disconnection between the equity market and Main Street. Ultimately, this is all very positive for gold. Very, very positive for gold, because you're talking about an environment where gold doesn't just go up because of the currency debasement. It goes up because almost everything else looks worse. That's just the truth of it. And you add fuel to the fire when you say, since June 1st, the institutionals, the insiders, right, the traders, they've been selling between 2 and 4 billion a week in stock. And you have all of the insiders that are selling at a 7-to-1 clip. And you have Jeff Bezos selling $6 billion in Amazon since June 1st. You have the 3 or 4 biggest shareholders and board members of NVIDIA doing the same thing, and Buffett with $500 billion in cash. At the same time, you have the mainstream, or you have the public, mainstream, mom, pa, all-time record in equities, all-time record in margin debt, all-time record in option exposure. You're talking all-time levered, risky, all-in and stocks greater than the great financial crisis, greater than the dot-com bubble, and the insiders are going the opposite way. Now, to your original question. So that tells me the insiders are saying, we're leaving the sinking ship right now, something's coming, and the public is the opposite, all in. But on the metal side of things, the public doesn't have much exposure at all. But what we have been seeing month over month is extraordinary. Extraordinary in the amount of gold that's coming into this country. The people who are incredibly sophisticated know what's happening. And I want to draw an analogy to say these people typically know what's coming before the rest of us do. They are able to get the playbook. And if you look at the fact that my whole career, which will be 36 years this February, less than 1% of COMEX contracts ever stood for delivery. Now, all of the gold that's coming into COMEX, what we know of, over 100 billion since the beginning of the year. And I would argue that a whole bunch more is coming in, not through COMEX. The biggest money in the world is importing gold in the United States at a level that no one has ever seen before. But more crazy than that, and I think this is a bigger indictment, and actually you got to wonder where the hell is it going and who's doing it, who's the big buyer. I think it's the Treasury, myself, or the Fed. But with all this gold coming in, less than 1% of contracts on COMEX, once they would post, like, okay, they expire August 1st, you can take cash, you can roll it forward, or you can stand for delivery. Less than 1% ever did. Just in the first 3 days of the August contract, we saw 2 million over 2,160,000 ounces of gold stand for delivery, which represented 100% of the 2,160 contracts that stood for delivery, that posted. 100% of them stood for delivery. And crazier than that, almost all of it is leaving COMEX. About 90+% of it is actually being offloaded. In years past, when we would see deliveries, people would say, yeah, but it's not really leaving. It's staying in the eligible category. There's eligible, there's registered. Eligible would be bars in the system that are owned by people like my clients in our Brinks JFK vault. We have a set of Brinks facilities around North America. Just one of them is COMEX, it's JFK. And the metal, the 1,000-ounce bars that my clients hold there, those are eligible. They could move to registered, which are the bars that back the contracts. But all forever, when stuff would come in and we would cite deliveries, you'd see in the comments, yeah, but none of it's leaving. What does it mean? Just goes back and forth. It's almost all leaving now. It's one thing to go into eligible and stay there. Right. It's another thing to go to eligible and registered, which could then be delivered. It's a completely different thing to see it leave out the door. And I want to make one last question. I'm sorry to go on, but I want people to understand that whoever is doing this, they're doing it for a far bigger reason than maybe we can even explain, because in that ecosystem that I have 9 Brinks facilities with one COMEX, I had a client who made an incredibly large order, and the silver part of it was all 1,000-ounce bars, and the gold part of it was all kilo bars. Now, this is COMEX compliant stuff. And my very dear friend is one of the primary Royal Canadian Mint distributors, and I was securing Royal Canadian Mint gold and silver bars that he stages for companies like mine at Brinks JFK. He has some at the RCM in Canada and some at Brinks JFK. She wants to store this stuff at Salt Lake City Brinks. He says, no, she doesn't. I'm like, what do you mean? Yes, she does. He's like, no, she doesn't, because it will lose COMEX eligibility and would have to be reassayed to go back in. And if you have these 1,000-ounce bars and you get someone like, Elon Musk says, I'll pay a $50 premium above spot for anyone who wants to sell silver right now or whatever, she's out of luck. I'm like, well, let me get this straight. It's sitting in Brinks facility. It gets moved by Brinks truck to Brinks Salt Lake City, and you're telling me that loses liquidity? I mean, it never left the ecosystem. It left the COMEX ecosystem. And even though Brinks maintained custody of it the entire time, to put it back into COMEX, it would need to be reassayed.
Let's just take a deep breath and think about what's really happening right now. You look at the Federal Reserve, you look at the unemployment revisions, you look at the layoffs coming through every sector, and you start to see the disconnect between Main Street and Wall Street like it's lit up in neon. In May and June, the numbers came out. 250,000 jobs created, 270,000 jobs created. Wall Street cheered, stocks climbed, gold fell. And then quietly, in August, the Bureau of Labor Statistics says, oops, sorry, we actually overstated by 400,000 jobs. The real number is closer to 78,000. That's not just a small adjustment. That's a fraudulently optimistic picture of the economy that gets walked back only after the damage has been done. So what's the Fed supposed to do in this environment? They want to cut rates to stimulate growth, but they're terrified of adding more fuel to the inflation fire. You look at M2 money supply, it's spiking again. Velocity of money is still at all-time lows, like pushing on a string. They pump liquidity into the system, but it doesn't circulate. The economy slows, layoffs rise, the average American feels poor, but the stock market stays elevated because it's addicted to cheap liquidity. This is the paradox that makes gold not just an inflation hedge, but the last safe asset standing. Because it isn't just about currency debasement anymore. It's about the fact that everything else looks worse. Equities are record high in leverage, record high in margin debt, record high in option exposure. The insiders, Buffett with $500 billion in cash, Bezos dumping billions in Amazon stock, Nvidia insiders unloading shares at record pace, they're all heading for the lifeboats. Meanwhile, retail investors are all in, more levered than at the height of the dot-com bubble. If you're not hearing alarm bells, you're not paying attention. The insiders are cashing out while the public is being left holding the bag. And yet, on the metal side of the ledger, the story is completely different. The public has very little exposure. You don't see the masses piling into gold and silver ETFs. What you do see is an extraordinary amount of physical gold flowing into the United States. The scale is unprecedented, over $100 billion since the start of the year. Just what we can account for through COMEX. And I would argue a lot more is coming in off the books. Now here's the part that really matters. It isn't just flowing in and sitting there. For 36 years in this business, less than 1% of COMEX contracts ever stood for delivery. These were paper contracts never intended to be settled physically. That was the game. In August, for the first time, we saw over 2.1 million ounces stand for delivery, 100% of the contracts that posted. And more astonishing than that, the gold is actually leaving, not sitting in eligible status inside the vault system, not shuffling between registered and eligible categories to make the books look balanced. No, this time, it's being withdrawn. Over 90% of it out the door. That is not business as usual. That is a smoking gun. Think about what that means. Whoever these buyers are, they don't want exposure to COMEX paper games. They don't want eligibility. They want their bars out of the system entirely. That tells you two things. One, they don't trust the system. And two, they know something is coming. I'll give you an analogy. A friend of mine who is one of the primary distributors for the Royal Canadian Mint had a client buying a massive order. 1,000-ounce silver bars and kilo gold bars. Standard COMEX-compliant products. She wanted them stored at Brinks Salt Lake City. Perfectly reasonable. He told me flat out, no, she doesn't. Why? Because the moment those bars leave the COMEX ecosystem, even if they're still in a Brinks vault, they lose COMEX eligibility. They'd have to be reassayed to go back in. That's insane when you think about it. Same bars, same vaulting company, but the minute they step outside that invisible COMEX border, they lose liquidity. What does that tell you? It tells you the COMEX system is a paper game propped up by trust and perception. And people with very big money are saying, we don't care about COMEX liquidity anymore. We want it out. We want it in our hands, or at least in vaults we control. Now, the obvious question, who are these buyers? Who has the kind of firepower to pull hundreds of billions of gold out of the system in a matter of months? The easy answers: China, India, sovereign wealth funds. Yes, they're buyers, but I'll tell you straight, I think it's the US Treasury itself, maybe working through the Fed or the Exchange Stabilization Fund. Because if you were in charge of the dollar, drowning in debt, staring at $28 trillion rolling over in 3 years, would you not be quietly rebuilding a gold position?
Yeah, the first 5 days of the August contract between gold and silver, almost $15 billion worth of stuff was delivered in 5 days. Now, it's much more than that now. This was 2 weeks ago, but it almost all left. Where is it going? Who's buying it? Why do we not know about it? That to me signals the people doing this are very wealthy, very sophisticated, know what the hell they're doing, and they wouldn't be doing this if they didn't see where we're going with our fiscal and monetary policy, and ultimately where gold and silver are going. So yes, I'm sorry to have belabored the question, which could have been answered much more easily, but yes, this will be very bullish for gold. Very, very bullish, as is the underlying fundamentals right now. Here are the numbers for silver for the first 5 days as well. So this would have been August 1st, 4th, 5th, 6th, and 7th. So they received into COMEX 1,721,192.54 ounces. That was delivered into COMEX, right? 1.721192. You know how much was withdrawn, left the exchange? 1,890,316 ounces, more left than was received. And so that's one thing, but the 1-to-1 ratio you're talking about of not rolling when they post, standing for delivery, no, there's no way it'll be 100, because it's typically 1% or, in that vicinity. To see it at 100% is, right. It's 4 feet of snow in Death Valley in July. This is very unusual stuff.
But even if it's 4 to 5% for the month, I imagine that is still very, diverged from what we normally see, correct?
Yeah, I mean, the moral of the story is not only are we seeing, players keep a lot of metal there because lots of deliveries are coming in and the numbers are going up, but they're withdrawing a massive amount of metals out of the vaults, and that in and of itself is, I think, really incredible. I mean, that's whipped cream on top of an unusual Sunday, because it's like these things just have never happened before, and now they are. So what does it mean, and who's doing it? Who's behind it?
Where do you think this is going? I guess maybe, do you think it's going into the Fort Knoxes of the world, if you think it's a sovereign buyer that's behind a lot of it?
If I have a thesis, I believe, if I had to guess, if I had one guess, I would guess it's Secretary Besant under the auspice of the Exchange Stabilization Fund, where, because it would be used for American security, he would not even have to run it by Congress, or at least in a very disclosed way, because I don't know, I guess who else could it be? Buffett, Bezos, a huge hedge fund. They're talking $100+ billion. Where is it going? And if you think about it, for those of you that own a mint box of silver, 42 pounds, 19,000 bucks worth of silver, well, what are you doing with $7 billion worth of silver?
What's I was going to say, this is a lot of mass.
You're talking semi-trailers full of it. Yeah. So I don't know where it's going. It's going to some people that are incredibly influential. And that in and of itself is also interesting, in that, how do you keep this quiet? Quiet to the point that none of the mainstream media even mentions the fact that you're seeing record inflows, more so than at any time since the Bretton Woods Agreement, where everyone sent us their gold. Record. This should be talked about. it's not. And the fact that it's not, and even I spend 3 to 4 hours a day, every day, 7 days a week, reading everything I can find across the globe, and no one has a clue who's taken possession of this. This is at a high level.
So let's drill even deeper into this, because it's not just COMEX we have to worry about. It's the LBMA, the London Bullion Market Association. That's the beating heart of the Western gold and silver markets. It's been around 140 years, and today it has the lowest amount of silver on record, about 155 million ounces. That sounds like a lot until you realize they're trading 190 million ounces a day. And according to David Jensen, who I think is one of the sharpest analysts out there, those 190 million ounces are just the posted numbers. Behind the curtain, they admit to trading 10 times that, closer to 1.9 billion ounces a day. That's 3.5 times the annual global mine supply, 15 times the float. Folks, this isn't just leverage, this is financial alchemy. They are creating contracts out of thin air, shuffling paper back and forth, while the underlying physical float keeps shrinking. And you know what happens when the float shrinks too far? The delivery mechanism gets exposed. That's what's happening right now. LBMA was supposed to be a T+1 settlement system. You trade today, the metal shows up tomorrow. Now suddenly it's T+8 weeks. The Bank of England blames a shortage of trucks and manpower. Sorry, but I've been doing this 36 years. I don't buy that excuse for a second. They're covering for the fact that they don't have the bars to deliver. This is why delivery is existential. In my entire career, less than 1% of contracts ever stood for delivery. Now you have sovereign-sized whales standing for delivery month after month, and almost all of it is leaving the ecosystem. The bullion banks can't just shuffle it around anymore. This is what Jim Sinclair warned about years ago when he said, "When delivery is forced, the game ends." At the time, I didn't understand how that could happen. Now I do. And it's not just gold and silver. Look at platinum. The head of the Japanese Metals Association recently said there's no platinum left in Switzerland or COMEX inventories, yet they're trading 3 million ounces a day in deliverable contracts. How do you trade something that doesn't exist? The answer is you don't. You fake it until the buyers force your hand, and then the system snaps. The rest of the world sees this. They're not stupid. The BRICS nations have already started building their own commodity exchanges. They're watching the West suppress prices in paper markets while they go around the world buying physical metal, dory bars, and concentrate straight from miners. Vince Lancy, another guy I respect, says China's been going directly to Mexico and Peru, buying silver before it even gets refined, before it's even officially called silver. They're disintermediating the Western system. They don't want it hitting COMEX or LBMA because those exchanges set the official price. They'd rather keep the West suppressing prices on paper while they scoop up the physical at a discount. That's a strategy, and it's brilliant. And this is where the geopolitics really kick in. People ask me, if gold and silver are barbarous relics, why is China flying dory bars halfway around the world to refine them themselves? Why is Russia even talking openly about making the ruble fully convertible into gold? Why is Saudi Arabia suddenly hosting gold conferences and setting up gold exchanges? Because they understand what's at stake. This is a race to control the world's commodities before the next reset. China already owns the London Metal Exchange, the LME, which handles base metals like copper, zinc, and tin. They're building warehouses in China to stockpile the physical that backs those contracts. They think in decades, not minutes. And they know that when the music stops, the side holding the commodities wins. So what does that mean for you and me? It means that price, the number you see on a screen, is the ultimate tool of misdirection. They misdirect the public with price and with rhetoric. They call gold a pet rock. They say silver is just an industrial metal. Meanwhile, they are vacuuming up the physical out the back door. I'll give you an example. In 2011, when silver touched $50 an ounce, U.S. mint sales hit records. People lined up at coin shops. That was the blow-off top. Today, silver's at a fraction of that, and retail sales are actually down year over year. The public isn't even in the game. The demand is coming from sovereigns and institutions. That's why this time is different. And let me say something about silver specifically, because I think it's the most undervalued asset on the planet. The U.S. Geological Survey admits the easy deposits are gone. Unlike wood, you can't regrow it. Silver is running out. For 5 straight years, we've had a structural deficit, demand exceeding supply. And that's before you factor in the coming tsunami of demand from solar panels, electric vehicles, and AI-driven electronics. At the current trajectory, industrial demand alone will overwhelm supply. The only way to balance the market is through higher prices, to reduce demand and incentivize new supply. That's how commodities work. But silver isn't just a commodity, it's monetary. Always has been. Every great financial panic in modern history has seen silver reassert its monetary role. The ratio of gold to silver has been 80 to 1, 90 to 1, even 120 to 1 in recent years. Historically, it's closer to 15 to 1. That reversion alone implies a 10-bagger for silver if gold simply holds its ground. And if gold is revalued higher, which I believe it will be to reset balance sheets, silver's upside is exponential. Let's not forget the states in the U.S. that are starting to legally recognize gold and silver as money again. Texas, Florida, Utah, they're setting up mechanisms for taxes and transactions to be paid in bullion. That's not symbolic, that's rebellion against the Federal Reserve's monopoly. And it's growing. Now, if you think the powers that be will just let this all play out naturally, think again. The exchanges are owned by the participants. If a short squeeze threatened to break the system, they would halt trading, cash settle, and arbitrarily set a price, just like they did in the tin market decades ago. But here's the thing, even if they try to cash settle, that doesn't solve the problem. It just accelerates the flight of metal from their vaults. Because once people see the emperor has no clothes, they don't come back. So here's where we stand. The Fed is trapped between inflation and recession. Insiders are dumping stocks while the public goes all in. COMEX and LBMA are hemorrhaging physical gold and silver. China and BRICS are building alternative markets. And the price on your screen is a mirage, a tool of misdirection. When the dam finally breaks, when paper promises can no longer be delivered in metal, the revaluation won't be gradual. It'll be violent. That's how all monetary resets happen. Roosevelt in 1933 devalued the dollar overnight by 40% and revalued gold from $20 to $35 an ounce. Nixon in 1971 closed the gold window, and gold shot from $35 to $850 in less than a decade. When the next revaluation comes, it'll be orders of magnitude higher, because the debt is orders of magnitude higher. I know that sounds dramatic, but look around. Central banks bought more gold in 2022 than any year since 1950. Poland, Hungary, Turkey, China, India, they all know the dollar-based system is ending. Even the IMF has been quietly rewriting accounting rules to prepare for higher gold prices. So let me leave you with this. You don't prepare for a fire when your house is already burning. You buy insurance in advance. Gold and silver are that insurance. And right now, while the public is distracted by the stock bubble and the politicians argue over soft landings and budget ceilings, the smart money is cleaning out the vaults. You can call that manipulation, or you can call it a transfer of wealth. Either way, it's happening in plain sight. The only question is, will you be on the right side of it?
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.